Understanding auditing, number 6, audits of inventory. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our email address and our phone number, and you'll see a related video, Auditing 3, Segregation of Duties, that ties into this presentation. Inventory audits, and this gets to a bigger question called, where did my cash go? If you are the owner of a business and you fund your business with cash, and 6 months, a year later, you look and see that your cash has gone down, the question is, what used up your cash? Where did your cash go? A retailer's biggest use of cash is probably inventory. If you can think of a Hallmark store that has greeting cards and other gifts, your cash has been spent on things that are sitting on your shelf. So a retailer has inventory as its largest asset. And let's talk about an audit report second, because an audit is often misunderstood to be a situation where an auditor is opining or signing off that the financial statements are free of fraud, which is not what they're claiming. They are making the claim that all the balances in the financial statements are materially correct. That is, they are so wrong or so out of balance that they would affect the decision that a financial statement reader might make. So they are materially correct. And one of the biggest accounts, especially for a retailer, is inventory. The auditor is saying, after doing his test work, that the inventory balance is materially correct. The risk is that the value of the inventory, which is an asset, is overstated, or that the dollar amount of the inventory is too high. That's the risk. There is risk if the auditor overstates the assets, like inventory, and understates the liabilities, like accounts payable. So what's our best evidence? Our best evidence of inventory is to physically count the inventory. If I hop over here to Excel, what you see is a balance sheet. And what I've suggested here is that we have $320,000 in equity, but we only have $50,000 in cash. So at some point we started the business, again I'll repeat, we funded it with cash, and we want to know, where did our cash go? Because prior to this date, January 30th, the cash balance was much higher. And I always tell people that in addition to inventory, accounts receivable, here listed at $120,000, is probably one of our biggest users of cash, accounts receivable and inventory. We are buying inventory, we own the Hallmark store, and we're putting inventory on our shelf. And when we sell things and we're waiting to be paid, that also ties up cash. So that's what's going on our balance sheet. I flipped over to a page for Plus Furniture Store, which is our example company that we're using in our inventory presentation. And we label something called account sheet, because the way that the auditor is going to physically count the inventory is to actually have a sheet of paper. And we're going to have all the inventory items numbered. We're going to have a description of them so we can identify them. And then we're going to have the dollar amount of the value of each one of those inventory items that are assets. And I'm going to assume that this list is much longer and that it adds up to $300,000, which was the inventory value that we saw over here on the balance sheet. There's the $300,000 in red. So we are going to walk in with this list, and we are going to identify each item. We're going to go over to the silver and glass lamp, for example, and we're going to check it off the list that we physically saw it in inventory. And that's what we're going to do a count. There's other concerns that we have with inventory. First of all, on a basic level, we want to make sure it exists. Where is my stuff? Do I see it in inventory? And secondly, what is it worth? You can imagine if you have a warehouse with inventory in it and somebody is walking you through and you notice that there's a pile or a shelf of something that you know is something consumers don't buy anymore, like cassette tapes or mood rings, if I can go way back in time to the 70s, anything that you can imagine that people aren't buying, and you ask the business owner, well, when was the last time you sold any of these items? And if it's been a long time, they may be obsolete. And if things are obsolete, they need to be written off, that is expensed, and taken off the inventory listing. The other question is, what condition is it in? Is the good in a condition that somebody would buy it? Is it not torn, broken? Does it seem to be in good working order? Now, there are some other risks to doing an inventory count. One of the things is that the area that you're counting needs to be static, and by that I mean access. During the count, no goods move in or out of the facility. No warehouse trucks, no employees in and out, no carts, no forklifts. Everything stops and is frozen in time. I already explained the count sheets. Each item is tagged with the number on it. So if the glass lamp is number 1, it's going to have the tag that it has the number 1 on it. The auditor agrees the number, the description of the item, and to the count sheet. If you saw the movie Fargo, there's a scene in Fargo where one of the characters owns his father-in-law's car dealership, and the bank is calling because they've done an inventory count of the cars and they're missing a few of them. The reason that they're missing a few of them is that the character in the movie Fargo is trying to commit fraud by not having all the cars in the lot that are supposed to be there to secure his bank loan. So it's an interesting scene in the movie. I also mentioned again obsolescence. The items that are gathering dust, are these items really sellable? One last concept I'd like to cover is sampling. With less valuable items, it's more reasonable to count a small sample of them rather than all of them. And I always use the example of bins at the dollar store. Let's say there's a big bin with black plastic combs in it. Well, rather than count each comb, it would probably be a lot more from a cost-benefit analysis. Don't invest time counting all the combs. Find some way to take a sample of it to make sure that the numbers are still there. We have to consider the cost of obtaining the information with the benefit of having it. Low-dollar items we're going to spend less time on. And perpetual inventory. Now we have point-of-sale technology with automated cash registers where when we sell something, cost of sales, and inventory get automatically adjusted. So there's less of a need to stop and count items, which is perpetual inventory. So the auditor agrees the point of sale information to the physical items. That's the end of part 6. I have my Facebook page here where we're going to start adding information. If you'd like to link to it, you can subscribe to my YouTube channel, Ken Boyd STL, all one word, for live tutoring and chat sessions one-on-one, my website, my email, and my phone number. Thanks very much for listening, and we'll see you next time.